Welcome to Economic Edge, your destination for crisp and clear explanations of complex economic and financial topics. In today's video, we're discussing trading liquidity risk, a crucial concept in banking and financial markets. Let's start with a fundamental question. What exactly is trading liquidity? Trading liquidity refers to a bank's or investor's ability to buy or sell assets in the market without causing a significant impact on the asset's price. In a highly liquid market, one can enter or exit positions quickly and quietly, without spooking the market or triggering large price swings. This concept is important for financial institutions like banks, which hold large volumes of securities. If they need to sell quickly, they should be able to do so without causing prices to crash or drawing unnecessary attention from other market participants. High trading liquidity also reduces the likelihood of counterparty risk because a liquid market allows you to exit deals or transfer exposures without depending too much on one particular buyer or seller. Why is this liquidity so important in trading? Because poor liquidity can lead to several operational and financial problems. Let's consider some key risks. Adverse market price movement. In illiquid markets, even small trades can cause large price changes. If you try to sell an asset and there aren't enough buyers, the price may drop sharply. Inability to liquidate at a fair price. You might be forced to accept a lower than fair value price just to exit the position. Forced liquidation and sharp price drops. When large institutions offload assets in a thin market, it can lead to steep and sudden price declines, creating a negative feedback loop. Complete inability to sell. In extreme cases, especially during financial crises, an asset might become untradeable. There are no buyers at any price. This is a full-blown liquidity crisis. Let's consider another important aspect. Why are emerging markets more vulnerable to trading liquidity risk? Emerging markets typically have lower market depth, meaning fewer buyers and sellers, lower trading volumes, and weaker market infrastructure. As a result, prices often diverge from their theoretical fair value during times of stress. Two main issues arise. Market shallowing, the number of participants drops, and trading becomes rare. Price distortion, because of the liquidity shortage, assets may trade far below or above their fair value. This makes trading liquidity risk even more critical to monitor in developing economies. This is why managing trading liquidity is critical not just for banks, but for the stability of the financial system. You might wonder, how is trading liquidity connected to market risk? The answer lies in the interaction between two types of risks: market risk and market liquidity risk. Market risk refers to the potential for loss due to changes in market variables such as interest rates, currency exchange rates, or stock prices. On the other hand, market liquidity risk is the risk that you cannot trade your assets efficiently because of shallow or inactive markets. What makes this interaction dangerous is that poor liquidity can amplify market risk. For example, in volatile conditions, if market depth is low, prices become more sensitive to trades. A small sell-off can trigger a much larger market reaction than expected. Two key questions arise here. How does price volatility differ in normal versus illiquid market conditions? How sensitive are asset prices to liquidity disruptions? These questions are central to risk modeling in investment banks and trading desks. Let's consider another important aspect. Why are emerging markets more vulnerable to trading liquidity risk? Emerging markets typically have lower market depth, meaning fewer buyers and sellers, lower trading volumes, and weaker market infrastructure. As a result, prices often diverge from their theoretical fair value during times of stress. Two main issues arise. Market shallowing, the number of participants drops, and trading becomes rare. Price distortion, because of the liquidity shortage, assets may trade far below or above their fair value. This makes trading liquidity risk even more critical to monitor in developing economies. Finally, let's break down the types of liquidity risks seen in trading. There are primarily two. Asset liquidity risk. This is when a specific asset, like a corporate bond or stock, cannot be sold easily, even though the rest of the market is functioning well. For example, a thinly traded municipal bond may lack buyers while treasury bonds remain highly liquid. Market liquidity risk. This affects the entire market. In a systemic event like a financial crisis or policy shock, liquidity dries up across all asset classes. Banks, funds, and investors all become risk-averse, leading to a market-wide trading freeze. Understanding both types helps in designing risk mitigation strategies for portfolios and institutions. If you found this video helpful, don't forget to like, share, and subscribe to Economic Edge.